A message from our sponsor. Need a current or retrospective SMSF property valuation? Whether it's for annual financial statements, pension commencement, or related party transactions, SMSF Property Valuations offers fast, reliable, and audit-ready reports across Australia. As an accountant or SMSF trustee, do you need a valuation that satisfies ATO rules, includes documented methodology, and ticks all audit boxes? SMSF Property Valuations delivers an easy online ordering process to finish the job quickly. Hello, everybody, and welcome to another episode of the Cross Country Super Podcast. And I'm joined, as always, by Jemma Sanderson over in beautiful WA and beautiful Perth. How are you, Jemma? It's great to see you.
It's good to see you too, Darin. I'm not sure about the beautiful bit at the moment. It's been freezing, freezing for us anyway. So hearing about
It's
this,
beautiful though.
it is. It's sunny and stuff, but it's just been really, really cold. And I know that you guys have had a heat wave, so a little bit of FOMO there, but also not really for a 37-degree day quite yet. Anyway.
No, fair enough.
Yeah.
And of course, this podcast is sponsored by a very, very valuable commercial partner of ours. So, need a current or retrospective SMSF property valuation, whether it's for annual financial statements, pension commencement, or related party transactions, SMSF Property Valuations offers fast, reliable, and audit-ready reports across Australia. As an accountant or SMSF trustee, do you need a valuation that satisfies the ATO rules, includes documented methodology, and ticks all audit boxes? SMSF Property Valuations delivers an easy online ordering process to finish the job quickly. And I can't emphasize how important valuations are because no doubt, I keep saying this. I know that we will see the fruition of this, but one of the topics, or the topic that we're going to discuss today, the Division 296 tax, is going to put more scrutiny on valuations, obviously, as you qualify or not qualify for the threshold that's been put in. So
valuations.
It's already a scrutinised area, but it's going to, an even stronger spotlight will be shone on that compliance issue. So no doubt, if you need specialist valuations, go and see SMSF Property Valuations, and no doubt they'll help you out. So thank you for their support. And I've just alluded to it as well, a bit of a segue, but I've given it away that we're going to discuss the new Division 296 tax proposal now. As you all know, this has been a talking point for seems like an age now, but last week the government actually dropped a new announcement which revealed the changes that they've made to the policy, which some of it is good and some of it was a bit of an unknown, really, not anticipated. And obviously the consequences will be nutted out.
Remain to be seen, almost, really.
Will be nutted
exactly.
out in the fullness of time, as Sir Humphrey Appleby used to like to say on Yes Minister. So there are aspects where we're still kind of waiting for what the details are.
Exactly. And it's going to be, I think it's like, I like the comment of the substantial consultation with the industry, and I hope that that actually comes to fruition. And there's a lot of speculation about how it's going to be administered and the additional compliance burden that it's going to place on SMSFs. Obviously, that's the context of what we're talking about, but also the big funds. So we've got a 5-page treasury paper, and that has some detail, but the nuances and all the devil in the detail is yet to be ironed out, and there's probably some more crinkles that will come through from that perspective.
You've triggered me already, Jemma, with that statement.
With the ironing.
No, you've triggered me because you mentioned that process, I suppose you could say, of industry consultation. And I know probably the way that the government is trying to sell this is that they've had a change of heart due to their previous industry consultation as to wanting to change it right now. The cynics amongst us, which I'm probably the lead cynic amongst us,
I don't know.
all
I'm sure you've got other people that would
know.
want to be the president of of the
Oh,
cynics.
I'm up there. I'm up there, Gemma. We all know that just about all the submission papers and all of the consultation that was held with the industry and key stakeholders as far as this policy goes was largely ignored. And
Yep.
need I remind you of the Treasury getting up not so long ago and saying in front of the media that they hadn't received any better methodology apart
Yes.
from taxing unrealized capital gains, which, as I will continue to call out, that was an absolute bold-faced lie
Yep.
because we've seen all of the submissions and just about every single one of them had a different methodology
Yep.
recommendation for this proposal. Now, I don't know whether or not they're going to sell it to say that, oh, we've had a change of heart and yes, we've considered it, but it's obviously not consistent with the Treasurer's message. And to cast a forward eye, I suppose I could say, Gemma, and this is where the trigger point happens, is that I don't think we should expect anything great from this next consultation process. Because
Well, the
what the change of
challenge,
heart was
yeah.
not about the first consultation process. So why the hell
No.
would they listen to anybody the second time round?
Well, I think that they're going to need everyone to provide them with because the so I didn't like the old rules. I'm not a fan of the policy. So I'm gonna say that up front. And I don't think anyone is a fan of the policy from that perspective, especially in the SMSF realm, because there's so many of our clients that are impacted by this. And by and large, most of the people that are impacted by this measure are in SMSFs.
Yeah.
So it's our industry where we're going to have the clients that are up in arms about it. So I don't like the policy. However, when you look at the new proposal and you can compare it to the old way was almost neat in terms of the compliance obligations and the administration of the provisions. What's your opening balance? What's your closing balance? What's the difference? Adjustments for contributions and withdrawals. That's your number. Your closing balance determines how much over the cap you were. And your tax flows from that. So the way that someone's having to do the ongoing financial statements and return for the fund doesn't change. The tax agent does it in the usual way. You're looking very pink right now,
No,
Darin.
no, I've turned purple again for some reason. So it's
Yeah.
happened before, but
Oh,
hopefully
okay.
it will correct
It'll
itself.
correct itself. That's all right. Bit of neon at early in the morning never goes astray. So that was neat. And now, of course, we've got at this updated proposal. Fantastic on a few elements there. Indexation of the threshold. Great. So that was one of the biggest criticisms of the original provisions. Unrealized gains are not included now. So again, fabulous. It's only realized gains. And in the Treasury paper, when you read it, it talks about a benchmark being taxable income. So you've got the taxable income of the fund that is then appropriately attributed between the members. And included in that consideration is you add back contributions. So your taxable income will include assessable contributions. So you take that off because that's not really showing the return, but you do add back in exempt current pension income. So those are how the provisions are working, and then the total super balance at the end of the year still determines what the tax liability is. Now, the kicker in all this and I understand why they would have included this, is because with unrealized gains out, then the level of revenue that they might collect from this measure would be lower because it would only be on realized gains. And so they've now introduced this second tiered threshold. So
Yeah,
that's
so
the $10
maybe
million threshold.
yeah, so maybe we should take a step back and talk
Mm.
about what the key you've mentioned a few of the key headline um, messages from the announcement. Obviously, one is that there's no taxing of unrealized capital gains
Yep.
anymore, which I think everybody's breathing a huge sigh of relief
Sigh of
on
relief. Yep.
because it didn't, obviously, that philosophy didn't fit with the approach of the rest of the tax system that the
Yeah,
country
exactly.
employs, which is obviously going to create a problem somewhere down the track. So that's gone.
Yep.
As you mentioned, Gemma, they've introduced an indexation mechanism on the thresholds being applied for the Division 296 tax, and that eliminates what I described as uh,
Bracket creep.
element of bracket creep
Yeah.
in superannuation, which I think would have been a terrible thing as well. Not that the government is doing anything about normal bracket creep as we speak, which is what the last set of tax reform was supposed to do, but it was
Yeah.
changed, which
Anyway,
didn't address that, which
baby
is
steps, Darin. Baby steps.
terribly short-sighted, but
Yeah.
a fundamental misunderstanding of how the economy and that sort of thing works, in my view. And of course, you mentioned also the thing that I alluded to, the thing that blindsided is maybe not the right word for it, but the thing that we didn't see coming was a second threshold. So the
Mm.
$3 million threshold remains, and that means that there's a 30% tax applied, or an additional 15% applied to people who have triggered that threshold and their earnings above that threshold. But then there's another threshold that they've introduced, and that's a $10 million threshold, and there's
Yep.
an additional 10% for the amounts of revenue beyond that threshold as well. So there's an additional tier, and as you alluded to, Gemma, I think that was in response to thinking that the revenue bonanza, if you want to call it that, that would have resulted from the taxing of unrealized capital gains is no longer going to be available. So they had to add another feature in, obviously, to try
Mm.
and, I
That's right.
suppose, compensate for some of that. Now, I will talk about this a little bit later. I have another theory that there's another
Right.
lever
Okay.
that
Well,
they
that's
might
interesting.
pull, which is a little bit sneaky. And but again, that will be the devil will be in the detail. But basically, I don't trust anything this government does as far as this policy goes. Yes, I totally agree with you, Gemma, that I'm against this policy because I don't think they've even disguised it that this is a tax policy aimed at SMSS
Yeah.
and nobody else.
Oh,
I'm not speculating. The government has pretty much said
said
that
that. That's what
themselves.
they've said. Yep.
And I think that that's very poor policy when you only target one segment of any part of the society, but one segment of the superannuation system like that uh, dictates poor policy as far as I go. So short of scrapping the whole measure, at
Which they're just
least
not going to do. Like
no,
they
and we
included
know
the
they're not.
revenue in their
Yeah,
forward estimates. So
100%. So we know they're
yeah.
not going to do that, but at least there are some common sense changes. It doesn't fix everything, and we will obviously go into that. But some of the more egregious
Mm.
and outrageous elements of it have been wound back, which is a good thing, short of completely scrapping the measure.
Yeah. But there's a couple of things in there. So that like their headline PR on it is high super balances, 30% tax under this new thing, and then a potential other additional 10% if you've got more than 10 million. Now, I think that that's obviously that is panic stations for a lot of people. They're like, oh, I could pay 40% tax on my super earnings. That is never, ever going to be the case. Ever. So, and I think it's really important to be clear on that because the 15%. So if you're over 3 million, even if you've got 50 million, the amount over 3 million, you've got that 15% potential, but it's an increment of that. So it depends on the extent to which you're over 3 million. That gives you a proportion, and that is the proportion of or call them the realised, the Division 296 earnings, that proportion is then taxed at 15%. So it's never ever going to be a flat 15. And likewise with the 10, it'll never be a flat 10, because it'll then be the proportion that you're over 10 that will have that similar application. And then really, because the lower threshold is anything above 3, so my example that I can't remember the upper figure I use, but if you go from 3 to 30, so you've got then, you're $27 million over, and then you've got from 10 to 30, you're $20 million over. It's not the way that the top line number is a subset of the bottom line number. So I've had people say, oh, you've added up the taxable income and I'm paying, that's more than the taxable income of the fund. So anyway, that's how that all works. So I just want to be clear on that, because of course again, the PR is this extra tax, which perhaps appeases the people that think wealthy people have getting all these tax concessions. So for those people that are going to be subject to this measure, then it's not, I mean, you've got to run the numbers. It's not necessarily that foul from that perspective. And if you're only just over 3, the incremental tax is hardly anything. And it depends on what your realised return is for the year. And I think that that's the other big consideration here is, again, the Treasury paper says taxable income adjusted for assessable contributions and exempt current pension income, and that's what it says. Now, since then, so that was on the 13th of October that the Treasury paper came out, and then straight away everyone was like, well, hang on a sec. If you bought an asset in your fund for $250,000 10 years ago, and then you sell it under, in the period of time that that was the other thing that's important. These new provisions don't kick in till 1 July 26. So
Yeah, I
they've
was
kicked the
about to
can down the
mention.
road for a
Yeah.
year. So let's say in the 27-28 year, you sell that 200. So you bought it for 250, then you sell it for $1 million. So there's $750,000 there worth of an assessable gain at the fund level, and you'll get a 1/3 rather discount. So there's $500,000 of taxable income sitting, or assessable income sitting in there. There might be some exempt current pension income on that, but you're looking at $500,000 that might be then caught under this measure. But then that's from 10 years ago you bought it for 250. So that just doesn't really sound fair, that you've got to pay this new tax on a gain that is attributable to before they even came into place. So the other announcement, and this is policy, this is sort of not legislation, because this is all speculation about how this might work, but what has come out is that a spokesman or spokesperson for the Treasurer has said it'll only be realised gains on increases since 1 July 26 that will be caught by this. So let's say that $250,000 asset was worth 750,000 at 1 July 26, then it's only going to be the realised Division 296 gain of 250 with a discount. Maybe, maybe not. That's what we don't know. That will then be caught by this. Now, straight away, I put my administration practical hat on and I'm like, oh, Jesus, we're going to have to be running multiple cost bases. So we're going to have our tax cost base, and we're going to have a Division 296 cost base. And so we're not resetting any cost bases. We're going to have a tax cost base at the fund level, and then because Div 296 is imposed on the individual at that level, we're going to have a different cost base. That's again the speculation. Now, how's that? How are we going to account? Well, we can account for that. The software programs will, have to be updated to deal with that. In SMSF land, you can then attribute that between members, again, up to 6 members in an SMSF, that can be done. Also, but how are the big funds going to do that? That's going to be an interesting consideration. And then so how are we going to report that? What are the disclosure obligations going to be? That's the other thing with what their annual return looks like. And the other thing with this is, and I don't know, I'm like getting on my high horse now. So So I might have an SMSF and I've got $1 million in there, and I'm thinking, well, I'm not even remotely close to this threshold. So I won't, like, why do I need to do any of this disclosure requirement in my SMSF? But I could have a defined benefit scheme elsewhere. I could have an APRA fund somewhere else. I could end up going over that threshold. So even though as a member, or like my account might not even be remotely close to that in that fund, the reporting is still going to have to be kept for the fund from that perspective. And again, that's not just in SMSF land, that's going to be in the big fund land too. So the administration of it has gone from it being quite neat, like I said earlier with the previous policy, which had bad outcomes from the unrealized gains perspective, to now being quite complex. And there's other bits and pieces in there that, anyway, it's just, I've got
Well, yeah, I
PTSD
mean,
from transfer
the,
balance cap implementation, and so I'm like,
well,
ah,
effectively, if you've triggered either of those thresholds, but obviously the lower one being $3 million, you're basically going to have to keep two sets of accounts in some,
almost.
and maybe even file two different tax returns, one for Div 296 purposes and then one for general fund purposes, which
Yeah,
I think is an absolute nightmare. Now, I didn't actually hear the announcement as to uh, the the trigger point being 1st of July 2026. I didn't hear that announcement to say that they'd done that, because I was actually speculating that if they didn't do that, and in your scenario, if they took the cost base from
from
um, date of
the from
purchase,
date of
the
purchase. Yeah,
10 years ago, that
yeah,
to me was potentially a cunning way of
getting some
making up
revenue now
for, yeah. Well, no,
because
no,
people
to make up for the amount of revenue that they were going to get from unrealized capital gains by
possibly, yeah.
taxing capital gains from the date of purchase rather than the date of implementation of this policy. And I thought, yeah, that's probably a tricky way for them to be able to do it.
Well,
So I
and
didn't hear that
also, yeah.
announcement from that point of view, but it doesn't, as you point out, Gemma, from an administration point of view, it's opened up a completely different can of worms, and we won't
Yep.
know how that's going to necessarily play out. No doubt during that consultation period, these these issues will be raised, but how they will be addressed, that's something that we can't predict.
Well, the other thing is, again, the disclosure of this. So the Treasury paper says the tax office will pull together all your total super balances. And if you're subject to this measure, they'll go back to the fund and say, please give us the realized da 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 da. Now, that's if that's how it works, here's the SMSF annual return, and then, oh, we need more, like the back and forth, inefficient. So I again am speculating it's highly likely that any of that information will be disclosed in the annual return. And that's more pages in the annual return, more disclosures, just extra administration from that perspective. Now, the other thing is if so that announcement or was from it was through, like, in the many articles just saying, a spokesperson for the treasurer has come out and said it would only be realized realized division 29, well, realized gains, I'll call it, since 1 July 2026. And so we've run the numbers for some of our clients already on this measure using the 23-24 info, because we haven't done 25 yet, looking at what the realized gains were in the year, and looking at the situation that, well, if 1 July 23, if the provisions applied then and was the first year, what were the assets worth at 1 July 23 that we sold in 23-24? So what might the taxable income of the fund versus the Division 296 realised gain. So the realised gain in this particular situation from a tax perspective after discount was about $1.3 million in this particular fund. And then when we looked at how the Division 296 realised gain would work, we had the situation where the value of the asset at 1 July 23 had when they sold the asset, it actually had gone down in value. So even though we had a taxable gain, because the cost base before then was a lot lower, we had a taxable gain, but a Division 296 loss. So, there's some quirky things that might arise there from that perspective. Likewise, we could have in this situation going forward a Division 296 gain, but a taxable, like a realized loss for tax purposes. So that's going to be some interesting quirks that come through. But I think the expectation is that we will be required to be disclosing this information in the annual return. That's just extra pages. And it sounds like, oh, it's extra pages. Everyone does it online anyway. Who cares? But that's just extra work from the tax officer's perspective to pull it all together and, update systems and all that sort of stuff. And with a 1 July 26 starting point, that like generally what people, because it's going to be the value at 1 July 26 that might be this new cost base, let's say, but they're going to have that the SMSF annual return for the 25-26 year done before. That's going to be interesting, that timing, because we've got no time. I mean, we're backing up a bit against Christmas already, and the whole universe shuts down for a couple of months. And then before you know it, it's 30 June and we're not sort of getting there. But anyway, I had some other speculation was that if we don't have a new cost base for Division 296 purposes, will people think or go, I'm not bloody paying this new tax on my taxable income when I bought the asset 10 years ago. I'll reset my cost base by selling that asset and going on from there. Now, obviously, they don't want people, a bit like back when the transfer balance cap came in, they allowed you to reset the cost base for tax purposes so people didn't just flog everything so they weren't paying tax subsequently. So again, we want to avoid that happening. But I think what will be prohibitive for people to sell stuff, unless that's the investment decision, is the people that are in this realm, more than 3, more than 10, then they have taxable amounts in their funds. They're not all exempt from tax with pension accounts. Some of them are, but if they sell that asset, then they're going to have some tax to pay now, and that will be the disincentive for them doing or selling anything to get a new cost base from only 1 July 26 where this new tax applies. Anyway, again, it's all very much speculation.
Oh, it's very, I mean, what you point out there, Gemma, it's very messy. I mean, you don't have to be an
So
expert on the
messy.
subject to actually realize, and we're definitely not trying to be melodramatic about this stuff. The actual practical implications are pretty much there for all to see. And
Mm,
as you say, the announcement only dropped, last week or at the
mm.
start of last week. And already, I mean, we're obviously not losing sleep over this and thinking about all these scenarios at night while we're lying
Oh,
in
I am.
bed. These are, but these are fairly face value questions
Mm,
that you raise immediately about, oh, okay, so this is what's going to happen, or what about this? And look, yeah, yeah, you've nerded it up more than most people, I think, Gemma, because I don't think I've ever heard anybody suggest the scenario where the tax treatment for one asset for general tax purposes in the fund versus Div 296 from the point of view of one reflects a gain and one reflects a loss has even been contemplated because like how if someone can explain to me how that would work, that the tax treatment for one asset is totally different for two purposes.
mm,
Um, I really can't see how that would work properly. And of course, we don't have to go into the myriad of compliance issues that this is going to raise because let's face it, with a calculation and administration procedure that complicated, it's going to be easy to make mistakes.
Oh yeah.
We
Yep.
don't know what the software providers, I mean, usually they get it pretty right, but we don't know. There's always glitches potentially when something happens, so we don't know whether or not, oh, we didn't actually account for this.
Yep.
I'd actually like somebody to explain to me, okay, so tell me how that's going to work. Do you know that that's a possible scenario? And how are you
The
going to?
challenge though is I'm just making this up right now.
Yeah,
This is all
and these are
theoretical. We don't know what it's going to look like. It could be that it is just pure taxable income if there's a gain that accrued prior to then. Too bad, too sad. I don't like, who
the
knows?
the fact that they made an announcement, which you've alerted me to earlier in the podcast, would suggest that this type of scenario is in the back of their mind.
Mm, yeah.
But whether or not they're competently equipped to deal with it, that's another thing. And of course, it's one thing to obviously recognize that, oh, no, 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 for Division 296, we'll only take it from the
1 July
implementation
26. Yeah.
date until, ad infinitum when you sell the asset. But that's just the obvious one, isn't it? Well, like what happens beyond that? But there's a whole myriad of compliance issues beyond that. If you're gonna set that deadline and that line in the sand, I'm not sure that they're equipped to be able to deal with that, Gemma. I'm sorry, these guys have not proved a level of competence to me that they're across all of this stuff,
And
including
how
the
you
trigger,
draft that
because
into the law, like that's the other thing, is what's the legislation going to look like? And then there's the practical implementation of it. And again, is it so you've alluded to, are we running two sets of accounts? Well, I'm kind of hoping we don't have to, but we're going to have to run definitely two sets of calculations each year, which will have a Division 296. I'll call it cost base. What's that Division 296 gain? The other thing with that is, so if it's a taxable gain and the asset's been held for longer than 12 months, you get a 1/3 discount. So it's only 2/3 of that gain. So it's a similar, if we've got a taxable income number that reflects realized capital gains, could be some realized losses in there with discounts applied, etc., of $1.3 million. I'm going to use the example I referred to earlier. So we've got that number there. Then there might be some non-discountable gains in there and some discountable gains. There could be some losses, all that. So that sort of gets taken off the number, and to add in then what your Division 296 realized gain is. So if you then look at those assets that were sold and you're like, okay, it's this, it could be a loss even though there's a taxable gain, it could be a gain even though there's a taxable loss, and then you land on a number. Is that going to be eligible for a 1/3 discount if the asset has been held by the fund for longer than 12 months? Or if you've got a Division 296 cost base at 1 July 26 and you sell an asset in that first year, are you going to have that, oh, well, you haven't held it for 12 months for Division 296 purposes and you're not going to get a So look, I'm just the complication. And I've got another one that hurts my brain quite a lot, which is, brace yourself. Okay, so we can run a cost base for assets of a fund based on the value at 1 July 26. So shares, managed funds, property, all of those sorts of things, right? Those CGT assets. Now, a lot of funds are invested in unlisted assets. So private equity, unlisted property trusts that might just have one or two properties in them, all those sorts of things. So let's say my example I gave earlier, where the fund invested in an unlisted property trust, 250 grand they put into it. Then the value of the units in that unit trust at 1 July 26 are 750. So there's $500,000 worth of paper gains, unrealized gains that at least we're getting some sort of credit for Division 296 purposes. Now, then in a couple of years' time, within that trust, the asset is sold. So the units aren't sold, but the asset is sold. So that asset, when you invest your 250, then they buy that's all aggregated with everyone else, and a $20 million property is bought. Then that is sold for $40 million after Div 296 comes into play. And there's a capital gain that's realised because of that, and that gets distributed by the trust through to the unit holders. Call that $500,000 for my fund here, for Bob's fund. So Bob will have a $500,000 capital gains distribution from that trust that will then form part of his taxable income, and they're discountable, etc. But then there's no Division 296 cost base for that distribution because it's come from a trust. So then if that trust then gets wound up because it's a single property trust, then if that happens in the same year, then he'll have a Division 296 cost base for that of 750,000. And let's say it gets wound up and he just gets his 250 back. So he'll have a Division 296 sort of loss then of 500. And then in this situation, I've got my, gain of 500. But often that they don't line up with their financial years. You might get the distribution of the profit in this year, but then the trust is wound up in the following year. So is your brain already hurting? So that's if it's a single property in this example trust. But let's say it's a trust that's got multiple properties in it, and you sell one of them, and that profit flows through, but there's no like Division 296 cost base of that asset that you can factor in. Now, we'll reduce the value of the unit trust when that distribution comes out, so that will flow through to the total super balance sort of thing. But you can see how that adds a layer of complexity. Now, I'm not proposing that we can run a Div 296 cost base on the underlying assets of an entity like that, because you can imagine with a private equity fund or a substantial managed fund that's got billions of dollars invested in it and thousands of investments, like what a bloody disaster. But again, those sorts of things, if this motherhood statement of only realized gains from 1 July 26 is that headline, then this sort of stuff is going to cause a complication.
Do you think that they could, for simplicity's sake, ignore the, whatever the treatment of the underlying assets in the unit trust is,
They're going to have to.
and
They're
just
just going to
treat the
have to.
distribution as income
Yeah.
rather than
So that
classify
won't, yeah. So that won't
that will
be,
be purely income
yeah.
without complicating what the actual characteristic of how that income was generated through the unlisted trust or company might have come about. I think
Yeah, that's
they've
the only
got
way
every
they're going to be able to
choice,
do it.
because
Otherwise, it'll be
otherwise
complicated. Yeah.
that's going to be a complete nightmare. And look, hopefully Treasury has taken some of the more simple aspects into account,
Yeah.
and they will rule out any sort of methodology that will increase the complication rather than quell it.
Yeah.
So we do live in hope as far as that goes, but you do raise some really good questions as to, we basically don't know how this is going to be treated.
And also there's
And
a fairness element of that is the challenge, because of the fact that if you can run a Div 296 cost base for the assets that you hold, but not then the underlying assets. And again, I'm not proposing that that there's an allowance for that, because again, like that's just complexity personified. And like I said earlier, it's not just the funds that are right now in the mix, in the scope. that will be doing this, it's pretty much going to have to be every fund because people can have multiple super accounts, and that's every fund in SMSF land, every fund in APRA land, every fund in defined benefit land, in terms of how like that's all going to work. So it's just, yeah, it's hurting my brain. And I've got other ones that equally hurt my brain when assets are segregated, and you can't segregate for tax purposes, but you can for accounting. So if you're allocating the way you allocate the returns for accounting is different to how the tax is paid, where because of the disregarded small fund asset threshold. So if that's the case, how which proportionate allocation are you going to be using for Diff 296 purposes? Is it the accounting one or is it the tax one? So yeah, like I said, my brain's been hurting, and you might not be up at night thinking about these scenarios, but I'm just going, right, how's it going to apply to this client and that client? And that's a quirk in that client situation. And this is a quirk here. And yeah, anyway.
Yeah, I think, Gemma, I think you're going to have to apply some discipline to just live in the moment for
I
now,
know, I know.
and not
But
and
I'm
not
being asked these questions though. So all these questions are being asked. How
yeah,
will it impact if this happens or that happens?
and that's fair enough. But and obviously one of the key messages that will continue right now is that no one can do anything um, until the legislation is
We
passed,
know, yeah.
because we don't actually know how it's going to work. I mean, I've used the analogy before. Someone could tell me that, oh, the speed limit's going to go down to 30 kilometers an hour, proposed, and I start driving at 30 kilometers an hour. It's like, well, why would you do that? It's not actually legislated yet. So a similar situation, you can't really do anything until it's legislated. And I think obviously the other thing is that 1 July 2026 implementation date, while it is welcomed, because I don't think that they had any choice with this,
Agree.
it's not the panacea that it would appear, because we're in nearly at the end of October now,
Yeah.
which really, if you take away Christmas and New Year, where not a lot of activity happens in the business world across the board, you're really only looking at 6 months.
You got 6 months.
6 months
Yeah.
again,
Yeah.
which is, I know the government will say, oh, but you don't have to do anything until 30 June 2027. But that doesn't, I've said over and over again, the as that window shrinks, comes with it all sorts. I mean, you're already being asked questions now,
Yeah.
Jim. And of course, this is complicated stuff, and you're going to have to go through some sort of scenario analysis and comparison to see what your strategy should be, going into the future, whether or not this tax is going to be a huge impost or nothing to worry about. So don't bother to completely rearrange your affairs
Your
about it.
affairs. Yeah.
But I keep saying, as the window shrinks, you can't do this without advice. Let's
Yeah.
be perfectly honest. You can't do this without advice. Now, advisors are not unlike anybody else. As the time period shrinks, they've got capacity. They've got capacity constraints
Capacity. Yeah.
themselves, right? And I know that every client wants to feel like they are the only person being serviced by Jemma Sanderson in the whole world, right? And that's human nature. That's
Yep.
natural. But the reality of the situation is not every client can be treated as the timeline shrinks as the only client in the world.
As the platinum A
Yeah,
class, top
exactly.
of the
That's just
wazza.
that's just
Yeah.
not going to happen.
Yep.
And again, I don't think the government does take this into account. And I think the 1 July 2026 implementation date might seem like a really great thing that we've bought ourselves more time, and we have to a degree, obviously, but
Mm.
not a considerable amount of time that you know oh, that's okay. We've got time to nut through all of these issues when you can't even nut through them before the legislation is passed.
Yeah.
So we're still in that sort of limbo, even though we've got slightly more clarity as far as how the
what it
policy
might
is
look
going
like.
to,
Yeah.
yeah, exactly.
But you know what
But
will
still, you
happen?
can't jump at shadows.
We'll get draft legislation on Christmas Eve.
Oh yeah, yeah, yeah.
That's my prediction. That's a prediction there. Um, yeah,
Well, to put
it's one of those things though where if so let's say instead of 1 July 26, they said the starting point is the so really like you were saying, it's total super balance at 30 June 27 that is going to determine. So we've still got time there, but we need to be doing stuff for a 1 July 26 valuation, cost
yeah.
base that we might be running, etc. And I had a point and I can't remember what it was.
Well,
It
not
was
not
very
just that.
relevant.
The software providers are going to have to get
Yeah.
on bikes pretty damn quickly as well. And we all know anybody who's been through a software upgrade or something like that. Hell, we had one with WordPress this week, which completely stuffed up our bylines on our website. Right? We
Oh,
had to go back to
right.
them and say, hey, what's going on here? And they had to undo the plugin or whatever or not they did. So it's not like any sort of software administration or maintenance doesn't come with issues. So they're
Mm,
they're going to have to get on their bikes and start nutting this out as well. And obviously, the sooner the programmers can get onto it, the better will be for it. But again, they can't jump at shadows either.
yeah,
They
exactly.
know what is set in stone and what you can do. Now, to be a real cynic, I actually think you're vying for
What? You?
I think
You're
you
not a
I think no, but
cynic.
I think you're vying for the presidency of the
Oh,
club.
no, not quite. I'm happy to be the
Yeah,
vice
because
president.
you mentioned that it was going to be passed or announced on Christmas Day.
Hey,
Well,
Christmas Eve.
maybe,
Come on,
well,
Christmas
Christmas
Day.
Eve. All right,
Christmas Eve. Christmas Eve.
give them a bit of credit, Christmas Eve. But dare I remind people that this announcement was made on the same day as the Middle East peace accord was announced.
Oh, on the 13th of October.
You don't think that
Yeah.
that was a coincidence?
Oh, I've got no
I
idea.
don't think that that was a coincidence.
Oh,
And the Prime
right.
Minister
Okay.
was off on vacation and just handballed it straight to the Treasurer, and he had to
Yeah.
answer all the questions. Like,
But it would have
if you,
been
if you,
a
if you,
very substantial loss of face if the Prime Minister had made the announcement rather than the Treasurer.
oh,
If if the Prime Minister
you
stepped
see, I
in and
don't
said,
know
"Oh
whether,
no, no, we're going to do this
but,
instead," it would have
but,
been, oof, geez.
well, maybe I don't think Albo would have looked bad.
No, no,
From
but the
the point of view of
Treasurer and the
oh
for the
yeah, well, I
Treasurer,
think the Treasurer's not got egg on his face. I think he's got a whole omelette on his face. Forget
a
about
whole
one
carton,
egg. He's got, yeah, he's got a whole
a
omelette
whole chicken
and
coop.
probably more than one. Um, but yeah, look, cynically, yes, I do think that they will make announcements when it's convenient. That it was a big news day about something else as well. But
So I
well,
remember my
this is
point
what's
now.
happened here.
My point is that let's say this, so that our value I will eventually spit it out. So total super balance at 30 June 27 is going to determine what the taxing position looks like. So in the 26-27 year, people can take money out to then lead into or determine what their Division 296, their total super balance is that flows through there. Now, if we kicked the can down the road for another year and had like that being 30 June 28, so then we're running a 1 July 27 cost base, I feel like it'd be another year's time and we'd still be having this conversation. So sometimes people work well or, people working under stress just get stuff done. So is that going to be the consideration of, well, it's 1 July 26. We just need to roll our sleeves up and just get this bloody done because that's just how it's going to work. Otherwise, it's another year. I mean, this was February 23. This like Division 296 or the $3 million tax was announced to start with. That was over 2.5 years ago, and we're still like in
But that's a convenient excuse.
talking about it.
But that's a convenient excuse because the excuse will be, well, you've been talking about it. We've been talking about this for 2.5 years. So what, it's not coming as a surprise.
No.
So, you know, it's your fault that you haven't done necessary preparation for the
But based on
implementation this
what?
way.
Like
But
we can't
yeah,
do
but
anything until you've
totally,
got
it's a flawed argument, but I'm sure
anyway.
that's an argument that will be put out. And I'm not saying my memory is perfect. I think it was announced on the same day as the Middle East peace accord. I'm pretty sure it was.
Right.
There was another massive news event, and I remember thinking to myself, "Oh, that's pretty convenient, isn't it? Just slip that one under the door, and oh, what else is going on in the world?
Oh, well, you were paying attention to
Nothing
the news
major,
far more than I
nothing
was
major."
because this just came through to me and I was like, oh God, that's not what I need right
Um,
now. But anyway.
so we again we go down the path of further speculation, and
Mm.
I wish the government would actually recognize the urgency with which this needs to be treated.
Actioned. Well, yeah,
Yeah,
an
yeah.
announcement with a treasury paper nearly a fortnight ago, at the time that we're recording this, then when's the consultation happening with industry? Uh, what does that all look like? All of those sorts of things. It's just then been crickets almost since then. Lots of speculation out there, and I've, been at the vice president of some of that. And so it's yeah, I'd like to see
Can,
where that's going to come through.
can I make a cheeky prediction?
Sure.
The consultation period will start 2 weeks before Christmas Eve,
Christmas, yep.
and you'll only have well, I'm being generous by saying a fortnight. You might only
Fortnight,
have
yep.
10 days or 7 days to get it in.
I'm not even going to bet you on that because I feel like
It's cheeky. I know it's cheeky.
I don't know. I feel like it's not inaccurate in terms of, but that's what needs to happen between now and so really it's the end of October. When we're recording this, there's a week left of the month, and then it's like November, and then a couple of, so 6 weeks, let's call it, maybe seven if you think leading up to Christmas. But from the 15th of December, people are on holidays, school finishes up, like all that sort of stuff. And then people aren't back until mid-Jan a lot of the time.
Oh,
So
totally.
things, if not Australia Day, is when people start getting back into it. School goes back, so I'm in the thick of it from that school perspective. So it's that's where my thinking is, and yeah, that's just then it's Feb. So if we don't get a consultation until Feb, then everything just then how again back to the software developers can't jump at shadows. They're not going to spend a shed ton of money developing or reviewing stuff until they know what it is they actually need to be doing. Likewise, the tax office with their administration systems. What do they need to be capturing in the SMSF annual return, in the tax return for the big funds? Like what information are they going to need? Like how is that going to work? So until we've got even draft legislation on this, we're not going to know. And so the consultation is just vital that it happens sooner rather than later.
Yeah,
And yeah.
totally, totally. Gemma, can I go back to one of the technical points that you raised
Mm,
in terms of exempt current pension income? Like, how is
yes.
that? Do you know how that's going to be treated? So, if you have ECPI,
Yep.
will that income not be exempt for Division 296
No,
purposes? Like, how does that
no.
work?
So in the tax return, and because I've been looking at this in the SMSF annual return, at I think it's question 11, item W, it says the gross income of the fund. So that would include all like distributions, dividend income, rental income, interest income, all of that is included in there. And you've got your realized capital gains in that figure. Then there's deductions. So the deductions that includes, sorry, also your assessable contributions. So your deductions then come off. So one of those is exempt current pension income. So that sort of comes off there, as well as you've got your expenses. So if you've got exempt current pension income, you're going to have a consideration of the expenses of the fund. Some will be deductible to the extent of it not being exempt, and some will be non-deductible because of what's exempt. Then you're going to have, now with that, you might have some proper non-deductible at all expenses, like a trauma insurance policy that the fund's owned since forever, that you just can't claim a deduction for that premium. There's generally not that many, some legal fees and things like that. Immaterial from ASIC fees, they can be immaterial for the process of this. So what will happen is that, say, then leads to, I'm just going to say it's $2 million of gross income. Then you might have some deductions. Exempt current pension income, let's call it, that's 700,000. So you're down to 1.3 million. Your assessable contributions are in there as well. There might be some deductible expenses. So then your taxable income is that $1.3 million figure that I sort of alluded to earlier. Now, when you're doing Div 296, what will happen is that $1.3 million taxable income, you will then add the exempt current pension income back on top of that. So that brings it up to 2 million.
Yeah.
Then you might take off your assessable contributions. So let's call that, say $60,000 worth of assessable contributions from the members.
Yeah.
Then the other consideration with that for Division 296 purposes, if you've had some deductible expenses and some non-deductible expenses because of ECPI, are you going to be able to then deduct for Div 296 purposes the whole of those expenses? I would hope yes, but who knows? So then for Div 296 purposes, you would then be adding that back in. Now, in this situation, so say we started at 2, our ECPI of 700 brings our taxable income down to 1.3, but then for Div 296, and in that 1.3, let's say that includes, in the 2 million, so we're going back up there. So let's say that includes $1.3 million worth of realized gains. So again, you deduct that off to get us down to 700. You might then deduct off that the actual fund expenses. Let's call that, I don't know, 50 grand. And then you take off there again your assessable contributions. So you've gone down to, now I've got to use my brain, down to 700 less, let's call it another 100. So you're at 600. But then you've got to add back your realized Division 296 gains. And that might be, say, with a $1.3 million taxable gain, it could be a $500,000 Division 296 gain gets added back. And then that's your number for Div 296 purposes.
The reason why I asked,
Clear as mud, right? Clear as mud. Yeah.
no. The reason why
Easy.
I asked is that effectively, if I'm interpreting this right, if your threshold is beyond the $3 million and you trigger the Div 296 tax, it effectively erodes some of your ECPI gain.
Yeah, but they're different things. So you've got the ECPI impacts what income tax that the fund is paying. So the
Yeah.
fund is then only paying tax on, in this situation, the taxable income of 1.3. And then for Div 296 purposes, you've just again got the proportion of the Div 296 gain at the 15%. Or yeah, so it's a bit like they're not apples and oranges, or they're more
I,
aligned to unrealized gains. The other thing, so we've again run the numbers for some clients on this, and this was one they were just under $10 million. And the effective rate of tax in the fund with their taxable income taxed, and then with the Div 296 gain included, I think it was under 20%, if not even a little bit lower. So it's still in that situation, and every situation is different, because if you could have a boomer of a year and sell an asset and make a massive gain, and that year your tax rate, and if your total super balance is high, your tax rate's just will be high on that proportion. But yeah, again, it remains to be seen how that's all going to flow out. So this is
Yeah,
the other thing is this is at the fund level, you're still going to have that the same tax position of 15% on earnings in accumulation phase, and that will include like a discounted capital gain at 15%. So realized gains held for longer than 12 months, basically taxed at 10, and then their eCPI. So that's not changing. It's just then that's all going to feed into, so that's at the fund level. And then so in the fund bucket and then in the individuals bucket, you're still going to have, that's where this Div 296 tax flows through. So I was commenting the other day that really the earnings within a fund could have up to 7 different tax rates applied to it. And I've since reflected on that and thought, oh, it's not really 7, it's more likely just 5. So in the fund, you've got 0 if it's exempt from tax. You've got, 10% with a discounted gain in there, but really that's 15 with a discount. If you've got non-arm's length income, that's 45%. So the rates of tax in a fund, there's 0, 15, and 45. So there's 3 there. Then in your own personal name, you've got a proportion of 15 and potentially a proportion of 10 if you're in the scope of these provisions. So there's 5. And if you look at the discounted, if you say, well, look, it's 10% on realized gains, that's 6. And then even if you've got a non-arm's length capital gain, if you've held the asset for longer than 12 months, you get a discount. So again, that's 30. So there's my 7 different tax rates on earnings.
yeah. Well, all that does is highlight the administration nightmare that
Yeah.
potentially will be. And just obviously, the more of these elements, as I said before, the more of these elements that you add in, the more propensity there is to make errors, and then you're going to have
Mm.
compliance issues and a whole
And
myriad
the
of other
higher
things that you have
reliance
to
we're
deal with.
all going to have on the software providers to do all
Yeah,
of this. And I think the other thing that's going to happen is the software systems out there are great, but they still require scrutiny as everything else because they might have missed some nuance or whatever. I don't want to throw them under the bus. They've been fantastic in like the evolution of doing things via Excel
yeah,
and through old school software coming through. But there's plenty of tax agents out there that can't justify the subscriptions for these software systems. And
no,
so, and the complexity of the funds that they're administering is it might only be a few investments in there, but they're big funds. And so Excel and all of those sorts of things and the software systems that they use for the rest of their practice, it's still not inappropriate for them to use. But if you're having to run 2 cost bases and then how all of that gets factored in, what that looks like. So whether they're going to have to, morph more and more people will morph into using the current software systems, or they're like too hard basket and they just the administration gets done externally. I can imagine that some of the tax agents that might do under 50 funds a year might consider that. It really just depends on, well, again, what the legislation all says.
okay. Well, we've run out of time,
I know
Gemma,
we have, yeah,
as usual.
as
So,
usual.
yeah. So, just wanted to thank you for your time for presenting this podcast with me.
Not a problem. It's always a pleasure to have a good nerdy chat with you, Darin. And yeah, this one in particular is well, it's just so interesting because I'm speculating substantially about how all of this might apply, and again, we just watch this space and don't panic. I mean, we just don't make any hasty decisions until we know more, because it's just
Yeah.
it's
An
just
old
so
cricket
challenging.
coach of an old cricket coach of mine used to say, whatever you do, don't panic. And I
Yeah,
think it's probably good advice in this situation right now.
completely, completely agree.
So thanks again for your time, Gemma. Thank you to SMSF Property Valuations for its support of these podcasts. Thank you again to my team for producing these podcasts and obviously uploading them on all the media channels that we do. But most importantly, thank you to you for joining us and listening. As usual, we hope you enjoyed listening to the podcast or viewing the podcast as much as we always enjoy bringing it to you. Other than that, travel well, and we look forward to having you join us for the next Cross Country Super podcast. Bye for now.
Bye.